Hello everyone and a very warm welcome to today's major markets update for August the 16th, 2023. The market can't get off the floor, so the bears are growling. Can we see 5 larger waves lower? That would really help us elucidate where exactly we are within the bigger picture. Please remember that the pressure remains down as long as we remain below 44.90. That's what we wrote in yesterday's update. Short term, as long as price remains below 44.90, we look lower. Intermediate term, as long as price remains below 45.90, we look lower. Long term, as long as price remains below 46.07, we look lower. There's nothing bullish other than some short-term scribbles to the upside to content ourselves with. So then we focus a lot on the short term to try to figure out where exactly are we in the starting gates of this C wave. Our primary expectation is the larger C wave. Why? Well, this is the chart I presented to you January 2023, that we completed primary A. We're now in primary B, to be followed by primary C of cycle A. Then we get cycle B to new all-time highs, because when the third wave doesn't do the trick, the B wave will do it. What is the trick? I would have liked to see the market go to 5,000 plus. The same here in 2018. The market stalled at around 2,900. I would have liked to see it go to 3,300. And that's what the B wave did of this irregular expanded flat wave 4. Remember, all fourth waves were either irregular or regular expanded to flats. Okay? So that's what we're now looking here for this super cycle 4 wave as well. All right, so we're going to get a crash, most likely. That's the primary expectation, which is just setting up. So this was what I shared with you January last year. So now we can look at what we have now. Filled in pretty nicely. I barely changed the labels, all right? The A and the B are still the same, and then we were looking higher. And we were looking higher to ideally 43.50, potentially 45.85. Well, it looks like the fibs have shifted tiniest little bits, happens. But we got there, and as you can see, exceeded it the slightest. Okay, the slightest, but still the same path, A, B, C. So we should now be in this path, okay? When the past is exactly as you anticipated it, then we anticipate the future to follow as well. So now we can look lower for ideally 2,700. 2,700 is very strong support. As you can see, it was resistant sometimes as well. So let's say somewhere at 2,800 plus or minus 100 for this A wave. We haven't even completed major 1 of this primary, okay? So there is still a lot of time for us to prepare for the third wave. We're not even close. We haven't even completed, in my humble opinion, wave 1. So this is what we had. We already said in October last year, if we go above, I believe it was about 3,800, then we should be looking for 4,300, 4,400. Well, we got 46.07, I believe it was, and that is as good as it gets. ABC, the general path has been there. Now, we can still do a 4 and a 5. Okay, the red 4, the red 5 are not yet off the table. As I said, I want to see this larger degree impulse lower. And it looks like we're just in the starting gates of it. So we're going to start here with the NASDAQ. Okay, this was the NASDAQ wave count. And I believe on Monday, it still looked pretty good here for this 5 waves lower based on this Fibonacci impulse pattern. Remember, we always start off with the standard Fibonacci-based impulse pattern. You can find that by going to my website, Intelligent Investing Market. Click on Menu, click on Education, Elliott Wave Principle, and here is the standard Fibonacci-based impulse pattern. Of course, we need to flip this one downwards, so we're now looking lower. But this is our initial anticipated path lower. With 3 of 3, 4 of 3, 3, 4, 5, where they should top and bottom. Okay, this is what we go by, and then we can see if the market decides to follow it. Is it going to extend? Is it going to be a little bit shorter? Is the third of the third wave longer? Maybe 238.2, then 4 goes a little bit deeper. As long as there's no overlap for week 1, so good. But this is what we go by. This is the initial puzzle we go by, and then we have to see if the market is going to follow it. Okay, there's no way of knowing beforehand if it's going to follow it, yes or no. That is just impossible to know. If that's what you expect, then your expectations are delusional. Very simple. You have absolutely no clue what to expect and anticipate in the market. So this is what we anticipate, and then we track it. We see if it follows. As long as it follows, it's fine. And then oftentimes the market decides to throw a curveball and do something else. That's why I always say we get it right 3 to 4 out of 5 times. Why? We probably nail the second wave, the third wave, the fourth wave, the fifth wave does something else, or the fourth wave or the third wave does something else. So you get about 3 out of these 5 waves correct. Okay, so that's what gives you 60 to 75% accuracy, and that's it. It's impossible to get every single wave correct. Once in a while it happens, but on average. So this is what we start with, and this is kind of what we got reasonably well for the NASDAQ. So we bottomed here in 161.8. It might be a little bit hard to see here, so let me extend that for you a little bit there. As you can see, there, right in that target zone, picture perfect. Okay. So I'm working here a little bit with the Fibonacci extensions. But the idea here is that the third wave should bottom in this box. And it did create a low. Then the fourth wave should go to about 100 to 76.4%, right? Fourth wave. See that? 176.4. That's what we go by. And it did so. Okay. Then the fifth wave should go to the 176.4 to 200%. Now I didn't write the 200% in here. We'll be on the next chart. And we bottomed almost there exactly on Monday. I think we were off by about $10. $10 on 13,500 is as accurate as it can be. And of course, the market decided then to throw the curve. Okay, that's what happens, unfortunately. So this one was bottom where it had to, this one. As you can see here, the third of the third wave goes about to the 100%, the fourth of the fourth wave to the 60 to 50% retrace. Is that what we see? Yeah, that's about right, 100 to 123.6. But then here, this fourth wave was a little bit deeper. It's okay, it was no overlap with wave 1. It doesn't have to be always picture perfect, but just to show you that as long as this is following it, we anticipate it to complete a reasonably standard impulse pattern. And now it threw the proverbial curveball. Crimea River, nothing we can do about. We don't know here that it's going to happen, what happened today, but we do know if we break lower, we're going to revisit now, as you can see here, the 200% extension. That's exactly what we've done. It's not on the chart, but that's fine. And this wave 4 is now extended. Okay. Here's the 200% at 13,468. It looks like wave 3 was this intraday low here before the Fed minutes were released. It looks like this step higher based on the Fed minutes was this wave 4, and that we're now in this wave 5 to about 13,400, 13,450, which gets us very close to this 200% extension. Okay, and of course we know that fifth waves are often equal to the length of the first wave. So we add that, and as you can see, it can go a little bit lower. Now, if we do then some Fibonacci work on this and say, well, is it exactly going to the 100%? We don't know, but so we use anticipated patterns. Then we say, well, that's the 100%, but we can have a 76.4 or even a 61.8. 61.8 has already been surpassed, which is here. So then the next target zone is then here for this wave 5. Assuming this wave count is correct, of course. And remember, it's all about how you interpret the first set of first and second waves. If you miss one set of first and second waves at the beginning, you will get it wrong at the end because you're missing a fourth and a fifth wave at the end. Miss 2 first and second set waves at the beginning, you'll miss 2 third and fourth waves and fourth and fifth waves at the end. Okay, so that's why it's so crucially important. How do you interpret the beginning of the new impulse lower, the new market direction? How do you interpret this? Is this 1, 2, 1, 2, 1, 2? Or is it simply 1, 2, 1, 2? Miss 1, right? Then you're going to miss the next path lower. So here, in this case, we have a rather extended third wave to 176.4. And then the wave 4 here to about 123.6, which is okay. What the market does is simply move the Fibonacci's lower. This is okay. A little bit of disproportion between the 4 and the 4 here. It's okay. You can still live with it. This looks like an extended impulse. So we bottomed here today where we had to for 3. We topped here for this wave 4. And we should now look for ideally 13,400, 13,450. Potentially as low as 13,350. We'll let the market decide. It could even go much, much lower, and I'll show you that with the S&P 500. But it goes to show you how important it is, how do you interpret this price action, right? As you might recall from previous slides, I said on the 5-minute chart, it looks like 5 waves lower, but I don't prefer to use the 5-minute chart because there's so many scribbles, it makes the interpretation even more difficult, okay? And remember, the Elliott wave is primarily designed to identify intermediate to long-term trends, not 5-minute scribbles. The Elliott wave is the best at the intermediate to long-term, okay? So you really, honestly, don't want to go any lower, in my own opinion, than hourly charts, preferably daily, weekly, monthly, potentially even yearly. So please keep that in mind on what we're dealing with, but it works really well, of course, on the hourly. And as you can see, this then was an extended 4-5 setup, 3-4-5 setup. We don't have to follow the ideal path. The market doesn't owe us anything. That's what we start off with. And then you go, well, it works really well. But we know if we break lower, then it's not the correct wave count anymore. But for now, look at this. It's following everything really nice. Third of the third wave bottom where it had to. The fourth of the fourth wave kind of topped where it had to. The third wave bottom where it had to. The fourth wave topped where it had to. The fifth wave bottomed exactly where it had to. So it is only logical to assume this is the correct wave count. Ta-da! The market says, screw you all, I'm going to do something else. And that's the proverbial screwball we get. 3 to 4 out of 5 times, you are correct. It's still better than Las Vegas. And if you expect perfection, then you shouldn't be on this planet because nobody is perfect. That's just the way it is. We're dealing with interpretation of the price action. You miss one set of first and second waves, you're going to get it wrong at the end. That's just the way it is. Okay? Remember, the pressure remains lower below this high we created, I believe, on Monday. Okay? As I said, 44.90. Below 44.90, pressure remains lower. Absolutely. So then we have here the NASDAQ 100, same wave count. And as you can see here, it can still go lower to this 14,700, 14,800 target. So as you can see here, 5 of A/1 targets exactly almost the 14,820 level. You can always extend. This looks also reasonably okay for 3-4-5 setup. Again, wave 3 bottomed so far in the ideal target zone. 3 of 3 as well. 4 of 3 just filled slightly. 4 filled slightly, but it still looks reasonably okay. Now we'll see. We need to get back above Monday's high to confirm the low is in place. Pressure continues to remain to the downside. We've had all this positive divergence, remember? But divergence is a condition, not a trigger, and it has been completely erased. And that's sometimes the way it works. So we'll see if we can get a low at 14,820. Somewhere around there. Potentially 14,690. Okay? Somewhere around there. But again, we got to follow the standard Fibonacci-based impulse pattern for as long as it remains valid. Okay? And so far, this has been reasonably valid. So we continue with this, and we'll track it accordingly. So how are we then on the S&P 500? So this is, in essence, the most bearish wave count, where we now in wave 3 of C/3. Ideally, a C wave for a larger fourth wave will bottom at around 43.80, potentially as low as 42.90. But if that's the case, then I'm going to really look for 3-4-5, because the C wave has gone, in my own opinion, quite too deep. But not until we see 5 waves lower can we be certain the blue B wave top has been in. And again, this 5-hour rally is, from a timing perspective, definitely not proportionate. But beggars can't be choosers. I don't make the market. From a price perspective, we got almost to the 50% retrace of this decline. So That's what matters most. And now we're going to track it 1, 2. We've gone below 44.10, so the trapdoor for this wave count has opened. That was the cutoff, 44.10. We've gone below it, so now this trapdoor has opened, and we'll see if the market can comply. First warning for the bears is back above this green wave 1 low at about 44.45. If we go back above it, then we have to concede that we might not see this impulse lower, but that we're going to see a bounce higher to about 44. Somewhere around this level, okay? Potentially gap fill, so somewhere around there. That's what I would be looking for. So that's our cutoff, okay? But we've gone below the trapdoor level of 44.10 on a closing basis, and that's very important. Because alternatively, we're going to do something like this, 3, 4, 5, and then bounce back for 2. Similar wave count, as you can see here for the NASDAQ, 4, 5. Okay, similar wave count, 4, 5. And then we bounce back, as you can see. So this is still possible. But the trapdoor has been opened. And clearly, we go back above 44, 45-ish, right? Then we have completed the impulse. Confirmed above 44.90. As long as we remain below 44.90, S&P 500 pressure remains lower. And also here, it's all about how do you interpret this mess. It's quite tricky. How do you interpret it? 1, 2, 1, 2, 1, 2 versus 1, 2, 1, 2. Okay, I can give arguments for both. So I'm presenting both. But again, this is then our primary path now. I want to see 5 red waves lower to confirm the blue wave B top is in place. So here's our math, 44.27, 45.27, then 3 goes to 42.90, as you can see here, potentially 43.25 for 38.2% extension, because that's our third wave target, so etc. That's only one of primary C, okay? Remember, that's only wave 1, 2, 3, 4, 5, okay? That's what we're going to look for. Now, it's always good to know what are others doing. This is work by Alfred Gilbert's group at wavetrader.net, and this is one of their most recent public posts, not sharing anything proprietary. They're also saying that this is quite a disproportionate wave 1, 2 here, A, B. They're also looking here for potentially C wave of this fourth wave, still not off the charts. If not, then we're going to rattle lower, same target zones as I have for this one's, because we're using the same Fibonacci levels. Okay, so we're looking for about the same setup. So we don't have primary blue B confirmed yet, but it's starting to look awfully good. Okay, so again, below 44.90, pressure remains low. Semiconductors, this is the ideal wave count for the semiconductors. And we had 2 options, as you might remember. We had the option of the ABC, that we have already completed, wave 5, okay? Because again, it's an interpretation 1, 2, 1, 2 versus a simple 1, 2, okay? I can make a case for both, but now the case for that first one is, of course, taken off the table because today we went below Monday's low. So now we have, in my humble opinion, 5 waves lower on the semiconductors, okay? So that is also an initial signal that we are in the first step of this impulse lower. Again, this was the cutoff. We could not go above the 61% retrace for this wave 4. We didn't. Unbelievable. Really looks like an impulse to me. This really looks like an impulse. 5 waves lower, 1, 2, 3, 4, 5. Very extended, as I showed you yesterday. Wave 4, 5 of 3. Also here, the third wave fell a little bit short. And now wave 5 should ideally target 3,400. So we're on our way, but we might stall at 138.2. Doesn't have to follow. This is, of course, a 5-1 relationship. But I think we're in this wave 5. Okay. If we continue to rattle lower, I'm going to look here for somewhere in this zone, of course, for a bottom. That is, of course, our bottoming zone. Okay. But I have 0 confirmation that the bottom is in place. That's our bottoming zone. Ideally, of course, here to about 3,400, potentially 3,300, but we can stall here at about 3,460, 3,400. This looks good. It's a little bit shorter third wave than ideal. Ideal are in green, but it's okay. As long as wave 4 doesn't go below 61.8, I'm fine with this. If it goes further down to 61.8, odds increase, it's not a wave 4, but it's stalled exactly where it had to. This one doesn't overlap. This one, it's reasonably proportionate in time and price. I like it. On to the Dow Jones. All right, what's the mother of all indexes do? Well, she is not behaving, okay? We were looking for a pullback into the gray target zone with a low here at about 34,760. We're right on the cusp of breaking below it. And we have, of course, still 34,600 as our cutoff level. Remember, as long as it quacks like an impulse, we continue to follow it as an impulse. Once it stops quacking as an impulse, we're going to look at something else, and we're getting awfully close. I can interpret this little higher high here as a 5 of 3 as well. Then still wave 4, it's going to go a little bit lower, and then a 5, etc. Okay, it is still possible, but the odds start to increase that we also might have topped for this one. And then we would be in the C of peak camp. Okay, so the cutoff, we know loud and clear. And then we have a 1, 2, 3, 4, 5 for this wave 1, 2, and then we're going to 3, 4, 5, etc. And we're going to go well below the October. Okay, so this still looks corrective to me. A, B, C. C waves don't have to be 5 waves, by the way. As long as it can be a 5, 3, 3 correction. As long as a B waves is 3 larger waves, that's all that matters. The internals don't care too much about it. IWM cutoff initially was here at 193 to tell us that this B wave potential topped. Then we said we should not go below 188.9. That's what we did on yesterday. So another nail in the coffin that we have indeed topped. With a false breakout, that was a nasty one, and it shows you how important stops are. Even if you get a breakout, there's no guarantee the breakout will hold. Okay, it tried here the very next day, so we were still good. Then we broke lower. Well, that is kind of your signal, and this doesn't look great anymore. So the preferred wave count is that we indeed have topped here for this blue wave B, with the potential for the E wave count, and then of course the B wave will be moved there. But I can tell you if that's the case or not. We'll have to have a lot more price data. For now, this looks really nasty. Again, the small caps have not told us anything other than this is a bear market rally. Nothing. Anybody who says this is a new bull market, honestly, was calling it way too early, because the small caps were not rallying with us. Okay, this is not impulsive looking price action to the upside. Also, why we were too early to call it a bull market, the NYSE AD line has not made a new all-time high. Since it made an all-time high in October 2021, yes, it's soon 2 years ago, soon 2 years. That's the longest stretch we've ever had for the AD line, by the way. I posted it on Twitter. Let me see if I can find it for you real quick. This one. No, not that one either. There, this one. As you can see here, this is how long, ever since the 2009 low, it took for the AD line to make a new uptrend high or a new all-time high. Okay, it depends a little bit, of course, where we were. So initially, it had to make uptrend highs, and then eventually it had to start making new all-time highs after the 2009 market crash. Okay, and as you can see, this is now the longest stretch ever. So this already tells us the market environment has changed. This is not to say here we're looking for several months to maybe at the most a year, but most of the time several months. As I said, we're almost 2 years in. So that is totally out of proportion. Also, in a bull market, you want to see the AD line rise. This is since the 2019 low. Look at that, what price did. Look at what the AD line did. Even the 2020 crash did not go below the 2019 low on the AD line. Okay, and what we're seeing now is no bueno, false breakout on the AD line so far as well. That's bearish. There's nothing bullish here to see. You want to see price rise, and here as well. And as you can see here, for example, right? So this is where we topped for the AD line, and how long did it take for the AD line to make a new all-time high? This long, right? So if you would move that to the market, you knew already here in June 2020 that a new bull was underway and had lots of upside potential. What are we doing now? Hello, it's not the same. What are we doing here? Okay, same here. Same here. Okay, so we topped here. How long did it take? Boom. All right, there. That's pretty much your signal to say, okay, we are already making a new uptrend high in the AD line. That's a bullish signal. Boom. Right? Same here. That was a bullish signal. Absolutely. And what do we have now? Nothing. So you have to be totally objective. I don't care about any of your studies for the long term from 2,000 years ago. It's all immaterial until I see a new uptrend high. This one supports our bearish case. Absolutely, 100%. How we're doing on new lows. New lows, yeah, it's low, so to say, 75-ish, 220s, but it's not good, right? Bulls are in favor, below 50 for both. Well, that we haven't seen for a long time, almost, for the NASDAQ. And NYSE is now also in the bearish camp. So the bears are growling. This data hasn't been updated. We're not yet in these crash type modes, triple, quadruple levels on the NYSE. So we still have some ways to go. Summation index for S&P 500 dropped today below 100. All right, now we're going to look, since the bear market started in 2022, how that resolved itself. I'd like to see these positive divergences. Okay, this doesn't tell me anything if we've bottomed already or not, because we can go much lower. And we often see positive divergence, not necessarily. Okay, so 1, 2, 3, 4 cases of positive divergence, 1, 2, 3 of no positive divergence. So 3 versus 4 tells us, let's expect positive divergence on the summation index. What does it mean? The index will go lower, but market breadth will make a higher low. So we have a lower low on the index, but we have a higher low on the summation index. You can really see it here, of course, in October, which had a triple divergence. Okay, so that is kind of what we want to see. That's a very strong signal. Okay, alternatively, we're just going to bottom out here, but we're getting extremely oversold. This is the buy zone, I would say. This is a reasonably okay buy zone between -80, -60. The buy zone is technically between -110 and -140, and anything below -140 is buy for the as super good swing trade. Okay, no guarantees that we'll go underwater for a little bit, but it looks pretty darn good. So that's what I'm going to look for. It starts to suggest we're getting pretty washed out, but I have no signs of a bottom, of course, being in place. Right? This one just tells us that market breadth is pretty weak, and of course the bears are in charge because market breadth is negative. The bulls are definitely hiding behind the shed. As such, the summation index, which has been on a sell since early August, correctly so, continues to be on a sell, but is now also getting oversold. Can get much more oversold, but now we're going to start to get some tailwinds. Okay, just like we had here, warning signs when it gets overbought. Yes, it can stay overbought for quite a while. Yes, it can stay oversold for quite a while. But again, eventually oversold will turn into overbought. That's what we're looking for. The ebbs and flows of the market. And of course, this one supports this one. So even if we're going to be oversold and negative for another week or two, right? Because the market will start to rally off negative values, this one will get extremely oversold. How we're doing on the PMO buy sell indicator? Well, that one remains on a sell since early August as well. But it's bottoming out. I don't have today's candle yet. It might have dropped into the ideal bottom zone, which I hope it will, because then we want to get an ideal buy signal once again. It doesn't work all the time, but nothing works all the time. So this one has been correctly on a sell, technically, since already late July, but it really confirmed it here early August. So also this one favors the bears. There's no buy signal, but that we're getting closer to a bottom. Okay, we need to see it. I don't see it yet. We have our wave count on our hands. Below 44.10 opens this path, which we're now going to track. okay? Alternatively, we're gonna bottom somewhere here about 43.70, kind of matches reasonably well here, as you can see here with this C wave of 43.75, and then it's off to the races. But as long as we remain below 44.90, pressure remains to the downside. Dow Jones is on the cusp of invalidating its impulse higher. Again, we track an impulse for as long as it works. If we top in the ideal third of the third target zone, it is a third of the third. Okay. If we then start to drop below the ideal fourth wave target zone, we have to reassess. That's how it works. Okay. I cannot foretell the future. All I know is, okay, we topped in the target zone, we're going to drop to this target zone. That has happened. So far, so good. Has this price action been less than ideal? Absolutely. But give it a little bit of time and it can resolve itself. It's okay this way. This works really well. That's why I say that wave works actually better on intermediate to long term. Why? Because then you have much more price data available to make a much better interpretation of the price action. So the AD line is 100% bearish. Okay, I need to see no all-time high. I don't care about the S&P 500 or any other index. It's all nice and dandy. Tom McClellan has, without a shadow of a doubt, proven that the only one you need to look at is this one. Everything else for all the other indexes are not the right tool for the job. This is bearish. This is bullish. And we've been waiting now for almost 2 years. And at some point, you're going to say, all right, the bus ain't coming. That's the way it is. You're standing at the bus stop and the bus ain't coming. New lows, still reasonably benign, but definitely too high. Bears are in charge. Summation index getting close to bottoming zone levels, but no sign it's in place. Are we going to bottom minus 110, minus 150 to be determined? Minus 150 is most of the time very close to very important low. So we'll see if we can get there. If that's the case, that would be fantastic because we'll get a massive counter trend rally once again. Okay. Positive diversion would be great. Not necessary. Also, this one suggests the bears are in charge, but we're getting a little bit closer to a low. Okay. Even if that low is just a bounce before we go lower, these bounces are definitely, every time you see it, definitely tradable because those are multi-day to multi-week bounces. Okay. Sometimes even more. That's all I have for today. Thank you so much for listening. Take care, trade safe, and I'll catch you all on Friday.